show this morning. It is 6:17 as we kind of get this pre-Friday Eve edition underway. Michael Lebowitz joining us this morning, talking a little bit about Fed, emergency rate cuts, elections, man, just all kinds of stuff we got to get into today. Morning, Mike, how are you?
Doing great. Thanks, Lance.
Well, so yesterday markets a huge surge yesterday. You know, it's interesting. I was just saying this during the kind of the monologue for the show that I've been doing this. Been investing money now for about 35 years, and I have never seen 2 weeks where you have consistent days where you are up or down 500 points or more in a day. The volatility has been absolutely phenomenal. I just haven't seen this before.
So it's funny you say that because I actually just made a chart that we're going to put up on our subscription service, RIA Pro, and it shows what volatility has been like from the lowest point in every day to the highest point in every day. Mm-hmm. And since 2008-9, we've actually had 4 or 5 instances like this. And I agree with you. I was kind of thinking the same thing. And then when I drew this graph, there were 4 or 5 other instances since the crisis. And I think why we think that way is because prices are so much higher. Mm-hmm. So, and a 100-point move at S&P 3000 was only a 50-point move at S&P 1500.
Right.
But it's funny. This morning I was also thinking that 80 to 120 is the new plus or minus 5 or 10. I mean, it's every day. We're up 100 and change yesterday. We're going to open up down 80-ish today. It's crazy.
Yeah, I know. And this makes it very difficult, for investors as well. I mean, yesterday was a good day. Markets were great. You feel good. Then today the markets are giving it all back. And it's like, oh, man, what's going to happen next? This is where it just makes it very, very difficult to try to make the right decisions, managing money, managing your portfolio, because, when you have this type of volatility, it seems like everything you do is the wrong thing. Because, you're good for one day, then you're not good the next day. And the question is, how does this work out? And I think this really kind of comes back to, the conversation we've had previously talking about the issues of what's happening with GDP growth in terms of, because of the global impacts of the supply chain shutdown, earnings are going to have to be revised lower, and markets are trying to figure out how to price all that in.
Right. And I think we're just seeing the tip of the iceberg here in the United States. I think Europe is showing us what's coming our way. Mm-hmm. And look, it's inevitable that school districts, entire counties, maybe even states are going to be closed, that factories, office buildings are going to be closed. And it's going to be a big hit to the economy. I mean, I see the economic hit to the Chinese economy is incredible.
Right.
I saw something that past auto sales in China for February were down 80%. Mm-hmm. I mean, that means people aren't getting out of their houses. They're not doing anything. So, you think, well, maybe it won't get that bad here, probably. But even if we see 10% of that, that's a huge hit to our economy.
Well, and again, I think that's the big thing is that, just today, Goldman Sachs kind of released some GDP estimates for the second and third quarter and, showing negative growth in the second and third quarter of this year. So technically, quote unquote, a recession, 2 quarters of negative growth. But it was interesting because the fourth quarter, we're back to 2% economic growth. We have this huge hockey stick recovery by the end of the year. Recessions don't tend to act that way. And typically, if you're going to get a couple of quarters of negative economic growth, it tends to kind of lag with you for a while, because once you start getting that mindset and you're cutting consumer confidence, these things tend to drag out for a while. So, recession risk, interestingly enough, I actually wrote an article about this for today that has now been lost due to a website crash. Hopefully we'll get it back. But wrote an article yesterday, was for today, talking about the risk of recession have risen markedly now over the course of the last month, much more so than we knew before. They have really come to the fore over the course of the last couple of weeks.
Right. And there are so many little implications. So I live in Bethesda, Maryland, or right outside of Bethesda, Maryland. Mm-hmm. And it is a town where they have been building condos and a lot of apartment buildings, and then on the bottom floor they're putting in restaurants and other type of retail stores. And there's a lot of restaurants in Bethesda, but there's a lot of people that live in those apartment buildings, as well as like where I live in houses that are within a few miles. So from a demand perspective, there's a lot of demand for these restaurants, but these restaurants continually go under, and they're always rotating, and new restaurants are coming in and old restaurants are going out, and there's always a decent amount of vacancies of restaurant space in Bethesda. So I've always kind of assume that the rent is very high, and if you have a bad week, if we get a snowstorm or if you get a lot of rain or a holiday type week, that they struggle, and it's hard to make do when you lose a week or lose a few days.
Right.
And now I'm thinking about these restaurants already struggle to stay open when the economy was great, when they're building all kinds of demand into the restaurant scene. And now what's going to happen when people start coughing and when the schools close and it's serious, when traffic gets cut in half? I mean, it's, you're not going to see it in IBM numbers or Microsoft, but you're going to see it in the local small businesses that can't withstand a shutdown or a partial shutdown of traffic for whatever their good is for weeks or even months.
Right. No, absolutely. And this is kind of one of the things that as we kind of look at the impact of this, what a lot of people haven't really factored in. And again, because the view is that this is still China. Oh, this is just a China problem. Right. The problem is that there's two parts of that. It's not really just a China problem. If you're trying to, as I said earlier, if you're trying to build an auto here in the United States, or you build a refrigerator or whatever it is that you build, if you're a clothes manufacturer and you print products, you print stuff on products, and a lot of that product comes from China, and we don't carry a lot of inventory anymore because shipping has gotten to be so fast now because of the way we operate. Most companies carry very lean inventory. So if you have a problem sourcing product for your inventory, all of a sudden you can't meet whatever demand you have because you simply don't have the product for it. So there's an interesting byline to this, is that this coronavirus may actually be inflationary to some degree because you can't simply get the product. So product scarcity eventually moves prices up as people start demanding those products.
That's right. And that's what we wrote about last week. Yesterday, we wrote about that while we're not saying it's necessarily inflationary, there's an inflationary risk, and maybe the Fed is fueling the fires of inflation. But back to kind of what you said, pretend you're a car maker and you make all the parts and everything in the United States except the gas pedals. The gas pedals are made in China. If that one part, the gas pedal, is shut down and you can't source it from somewhere else at any cost, you can't make cars. And just about everything that we use has at least one part that's coming from China, and now maybe Korea and some of these other countries where they're shutting down.
Right, and again, then that doesn't even include the fact that if we actually get a spread here. I was saying earlier, there's a Princess cruise ship that's now docked off the coast of California. They won't let it in. There's potentially a case of coronavirus on that, so they're flying in test kits to try to test all the passengers. But cruise lines, airlines. I showed a picture yesterday on Twitter of my wife. She went to Intercontinental Airport on Tuesday, vacant. And you never see that at Intercontinental Airport. No lines at Chick-fil-A. That never happens. When you see that type of stuff, there's already impacts occurring. And if we do actually have an outbreak in the U.S. To some degree, it's not the actual virus itself. Again, it's not people getting sick. It's how people respond. If people start going, hey, I'm not going to go to the office because I don't want to risk getting sick. I'm not going to go to the store because I don't want to risk getting sick. Those actions lead to a reduction in consumption. Consumption makes up 70% of the economy. So that's the key factor. It's really not the virus that's the problem. It's the psychological impact. It's the changes we make as consumers that becomes problematic for the economy.
That's right. I also think it's how quickly governments and corporations are reacting and shutting things down. The other thing I'm thinking about is it's allergy season up here. We're getting a bloom that's 2, 3, 4 weeks earlier than normal. Right. So I already feel it. I'm starting to cough a little. I get the the sneeze going.
Coronavirus.
A lot of people are going to get that, and a lot of symptoms are similar, Lance.
Yeah.
It's, what are the schools going to do when they have 300 kids that have potentially allergies or potentially corona? You know what they're going to do? Schools up here now shut down when there's half an inch of snow.
Half an inch. We shut down if we shut down if it rains too hard. So
they've become really protective over the last 10, 20 years regarding snow. So I can only imagine what the schools will do when a few kids are showing, corona-like symptoms, even though it's probably not corona.
Yeah. Why do I suddenly feel like my father shut down for half an inch of snow when I was their age? I had to walk uphill both ways, fight bears with my notebook, right?
Exactly.
We didn't shut down for anything.
Exactly.
Wimp. Exactly. So yeah, suddenly just had that hearing of my father in my ear. So all right, look, Mike, when we come back from the break, let's switch gears here a little bit. Talk about the Federal Reserve emergency rate cut. Intermeeting did this emergency rate cut, 50 basis point cut. Was that political pressure? Was that actual response to what they actually believe is happening in the economy? And more importantly, what does that mean for their meeting coming up? Do they cut again? We'll talk about that with Michael Lebowitz. Come back from the break. Don't go away.
So they all come and dance beside me. Move with me, chat with me, and if you're good, they'll take you home with me. Dale a la cuerpa, alegría, Macarena. Pues su cuerpo, dale a la alegría, cosa buena. Dale a la cuerpa, alegría, Macarena. Hey, Macarena, all right.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
A modern day warrior, means right.
And welcome back to the show this morning. Michael Lebowitz joining us live, talking a little bit about Fed, markets, volatility, all this kind of crazy stuff that's going on. We're talking about yesterday, Joe Biden, of course, he did well Super Tuesday. The market liked that. They liked the idea of a kind of a perennial establishment candidate being the Democratic nominee versus Bernie Sanders. If you're Bernie Sanders, he certainly can't be happy about that. And it's funny, he says that he'll concede if Biden wins the plurality of the delegates. So we'll see how graceful this becomes. I suspect he winds up trying to run his campaign as an independent.
Yeah, I'm not so sure he's going to give up so quickly. Him and his supporters feel they got robbed 4 years ago.
Yep.
And this is his last chance. He's not going to run in 4 years. So it wouldn't surprise me if this becomes a bigger story, especially if he can keep holding on and winning a few states and keeping up with Biden.
Yeah. It was interesting, though, Wall Street odds today. I posted this chart out on our Twitter feed, that the Wall Street odds today of Biden being the presidential nominee has spiked dramatically, and the reverse, obviously, for Sanders has dropped sharply. And again, the markets like that yesterday. Today, markets trying to are going to give up back some of those gains, maybe profit taking, maybe focus back on concerns about the coronavirus. But more importantly, the Fed did come in here and cut rates. And, this is what, President Trump has been wanting. He was tweeting out on Monday that, the Fed needs to cut rates, be more aggressive with easing. We need to be like other countries around the world that are doing it much more aggressively. And kind of my question is why do you want to be like the other countries to some degree? Because if you take a look at other countries that are aggressively cutting rates and doing a lot of QE, they have negative interest rates on bonds. Their economic growth is extremely slow. If not recessionary, if you take a look at Japan. I'm not sure why you want to emulate these other countries.
And what's shocking is they don't understand the correlation between low rates and low growth. And one promotes the other. And it's a self-fulfilling circular problem.
Right.
So if that's what we want to be, if we want to be Japan that has had almost no growth for 20 years, or Europe that's had very low growth, we're on that path. And the more they cut rates, the more they're incentivizing speculation. and not true investment into our economy, which historically is what has made this country so prosperous.
Well, I think that's interesting, right? Because, when you say that, the attitude, right? The attitude from, everybody from the White House over to the Fed themselves, they believe that low interest rates stimulate borrowing, right? If I lower interest rates, people are going to go out and they're going to borrow money and they're going to go buy stuff and do stuff. But there's not actually a direct correlation between low interest rates, economic activity, and stronger economic growth. Business investment, as an example, has been declining sharply. Yes, we've had low rates. And what have corporations done with low rates? They borrowed money to go buy back shares. They didn't borrow money to go build out new plants or expand production or hire more employees. Everything that was tax cuts was supposed to do the same thing. Give these corporations tax cuts. They're going to go hire a bunch of employees. They're going to give everybody wages. It's all going to be good. It'll filter down the economy. Didn't happen. Corporations went and they took the lower tax rate and bought back shares. So, they do what's good for themselves, but not really what's good for the economy. So if people don't act the way that the economic theory says they should act, then we should probably think about doing something differently.
Right. Because the path is laid out for us. Europe and Japan have laid out the path, and we're just following blindly along without any thought that maybe low rates are bad, that maybe we have a debt problem, and that the right answer is not to make people take on more debt or to make debt easier to service. Well, maybe find ways to reward and incentivize people that are actually making investments in productive ventures.
Right. Well, that's where you would focus your tax cut, right? Make a business investment. We'll give you a tax deduction for that. Instead of giving blanket tax cuts, make your tax cuts targeted towards specific actions. If you buy a fleet of vehicles for your company, you can use that for a tax deduction. If you give wage, look, you want to promote wage growth, R&D. If you want to promote wage growth, right? We'll give you a credit for increased wages. I mean, there's a lot of things you could do to specifically target tax cuts to make them actual beneficial in the economy. Unfortunately, we just don't do that. We kind of do these blanket actions that typically have the actual reverse outcome that we were hoping to get in the first place. But going back to the Fed emergency rate cut. So here the Fed a couple of days ago, actually last week, they were talking about, it's like, hey, we're watching everything, but we're not looking at cutting rates, doing anything important here. We're kind of watching the virus and seeing how this develops. On Tuesday, Jerome Powell and Steve Mnuchin are talking to the G7. After the G7 meeting is over, there's a statement that's issued, and the statement says, we're going to act with the other central banks to help, provide liquidity and kind of support the economy during this viral outbreak. But there were no details given. And within 2 hours, then the Fed comes out and announces a 50 basis point rate cut out of nowhere. What was that message that they were really saying? It almost smacked of fear from the Fed rather than a strategic move.
It was definitely fear. Even on Friday, we were talking about this all week, that there must have been a dozen Fed speakers, and they were all reading from the same script, that we're going to sit on our hands. We're not going to do anything until the impact from the virus is much more well-known and it's hitting the economy hard, right? Even on Friday, Bullard from St. Louis and Richard Clara, the vice chairman, said the same exact thing. Nothing really changed over the weekend or on Monday other than the market moving. And then Tuesday, they do an emergency rate cut. Emergency rate cuts, they called it an emergency for a reason because they don't happen that often. They're pretty rare. Right. And they're usually things they're events that are not good. Market reacted positively. But what's interesting is on Monday, the Fed funds market was pricing in a rate cut. So we weren't totally surprised when they actually cut them on Tuesday, right? Because the market was expecting it. But it was said that it would be in coordination with the Bank of England, Bank of Japan, the ECB, right? So they all had their conference call on, Monday morning?
Yep.
Nothing happened. Tuesday morning, the Fed cut rates. I haven't seen the Bank of Japan, the Bank of England, and the ECB cut rates yet. So why are we they're doing other things. Japan has been buying ETFs hand over fist, but why are we the ones cutting rates and not them? And if you notice, the dollar has gotten hit pretty hard over the last week or so, last 4 or 5 days. Maybe this is a dollar thing, but it just reeks of desperation.
Well, it's interesting you said, because we have a meeting coming up. The Federal Reserve has a meeting this month at the end of the month. So does the Bank of England. So does the ECB.
Right.
They all have their meetings at the end of the month, which is where they normally announce policy changes. And it was interesting because the ECB, the Bank of England, Bank of Japan, they're all talking about, hey, we're going to take some action here. But again, to your point, they haven't done anything yet, and everybody's expecting that they will take action at their meeting. The Fed could have just waited till the end of the month to cut rates. It's not that far away now.
It's March 18th. It's not even the end of the month. It's a week and a half.
So you wait. Yeah, you wait till the meeting, and then you cut rates. But now they've cut rates, and the expectation is they're going to cut rates again on the 18th. Now, Fed Governor Bullard came out yesterday and says, "Hey, don't count on us cutting rates on the 18th because we've already cut rates." But history says that every time there's an emergency rate cut, the Fed always cuts at the next meeting.
Right. I use a hashtag on Twitter called hashtag Fed gibberish. And this is exactly what it is. They say one thing, they do another. And this has been going on for years and years. If you look at what they say and look at what they do, they can be two different things. And it's very concerning, right? Because our economic system is in part built on trust and confidence in the Federal Reserve. And at what point does the market lose confidence in the Federal Reserve?
Right.
Remember, Lance, they have lowered rates 1.5% over the last, 9 months?
Mm-hmm.
Think about that. The economy is fine. Unemployment's the lowest it's almost ever been since at least the 1950s. Inflation is ticking up, which is what they want. It's, the economy will definitely slow down because of the virus. There's no doubt, but there's also very little doubt that this is just a bump in the road. It's transitory. It may last for a quarter. It may last for 4 quarters, 3 quarters. We don't know, but we know it's transitory. It's not a permanent scar to the economy.
Well, and that's kind of the important thing here is that this is going to be transitory, but we're taking these actions that have longer-term negative consequences to the markets and to the economy. We'll talk about that when we come back with Michael Lebowitz after the break. And also, just to touch on a bit about what does this mean with the 10-year Treasury now below 1%. What does that mean, and where do we go from here? And really, we've been long bonds for a long time now because we were expecting rates to get to this point. Question now is, what do you do from here? Come back after the break. I'm your host, Lance Roberts. Don't go away.
You want to be tough, better do what you can, so beat it. But you want to be bad, just beat it. No one wants to be defeated.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
So headline news just a moment ago, OPEC has cut production. So oil prices are up a little bit this morning. It's interesting. OPEC keeps cutting production, trying to get oil prices up. And we all run out into the West Texas and drill as much as we can. So at some point, we're going to have to start thinking about cutting our production here in the U.S. if we want to get support for higher oil prices. I was just looking at a chart this morning. We're now producing more here over the last 2 years. There's been this huge increase in production in oil. Of course, now we're now a net exporter of oil because we have so much of it. But at some point you have to kind of think about balancing supply and demand at some point. And I'm just curious how long OPEC's going to get to the point where it's like, okay, we're just going to stop producing oil at this point. Just to see what happens from here. So
right.
Anyway, Michael Lebowitz joining me this morning. So let's talk about a couple of things here. First, we talked about the fact, the Fed cut this, did their emergency rate cut here, 50 basis points. Typically in the first, few weeks after they cut rates, markets tend to perform a little okay, not great. But historically, these emergency rate cuts have preceded bigger declines in prices over the course of the next year because they generally precede some type of event, right? They're cutting rates because they have an expectation or they're concerned about some type of economic event, which doesn't weigh well on stocks. So the question now is for them, they've cut rates, and are they banking on potentially, or at this next meeting on the 18th, are they going to talk about doing quantitative easing to try to support asset prices?
Well, that's what's a little more concerning about this and more unknown about this event than prior reasons that they've cut rates. In the past, they've all been financial, economic based. Mm-hmm. This is, except I guess 9/11, but this is different because we have a virus and we don't understand it. We don't know how it's going to spread. We don't know what the effect on the economy will be. And we know for a fact that lower rates in QE are not the vaccine for this virus. So the Fed can do things to try to support the markets, but it's all a confidence game. And how long will the markets say that they think that the Fed can continue to do that? Mm-hmm. It's trust. And look, it may work out. The Fed may be able to lower rates to zero, may be able to do massive QE, and the markets say, who cares about the economy? Who cares about corporate earnings?
Right.
The Fed provides liquidity. We're going to buy. Right. Could also be that people say, look, Fed doesn't have the cure for this. The Fed can't really do much. The economy is gonna fall. Corporate earnings are going to collapse. Mm-hmm. You know what? I'm selling. I don't care that the Fed is doing whatever they're doing. Right. So that's the kind of fork in the road that we will probably be forced to come to pretty shortly.
Well, and again, and it's also too, we wrote articles starting back in 2013, actually. Jeff Gunlack, Bill Gross were talking about how interest rates in the 10-year Treasury were going to go to 4% and 5% because we have, all this economic growth, things are going on. Interest rates need to be higher. When we got tax cuts, interest rates were going to surge because of the tax cuts because it's going to lead to such, booming economic growth. We've been writing articles ever since then saying, no, interest rates are actually going to go to zero for a whole variety of reasons, primarily because of of being such a debt-laden economy. So we've been very long bonds in our portfolio. We, every time interest rates did tick up for any reason, we'd be big buyers of bonds and add them to our portfolios. We've recently added positions as well, just earlier this year to our bond portfolio, and did some minor changes. But we continue to consistently be buyers of bonds because we continue to expect rates to go lower. Well, our target of zero is fast approaching. We're at 0.96 on the 10-year Treasury. It's incredible. This is, by the way, if you don't understand this, the 10-year Treasury in the history of the world has never been as low as it is today. So, right. I mean, you're 0.96 of 1% on the 10-year Treasury.
Right. Let's stress that because there is history going back to the 1600s in England, history back to the 1700s in the United States. And it is below any record seen over those 500 years.
Right. I mean, you're basically saying this is, to put this in perspective, this is your cousin coming up to you and saying, hey, can I borrow $100 from you? And I'll give you the same rate of interest that you get on the 10-year Treasury. And so at the end of the year, he comes back and he gives you 96 cents. Right. An interest. That's what you're getting, very little interest on your money. And what's important is that this is also over in the high yield market, which is Wall Street lingo for junk bonds. We have some of the most compressed yield spreads on junk. I mean, the stuff that you are likely not going to get paid back on, you are not being paid to own that risk.
Right. There's a risk reward function too. And if, say, 10-year rates were at 3% and we think rates can go to zero, well, the rate can go from 3% to zero, which would be called an approximate 25 to 30% price gain. Forget the coupon that you get. But we're at sub 1%. That means your upside is called 8 to 10%. And you're going to get paid a 1% coupon, which is nothing. your downside is tremendous. So that risk-reward equation keeps shifting against you as we get closer and closer to zero. So a lot of people, most people that own bonds at 1%, don't own them because they want the 1%. They own them because they think the price of the bonds will rise, which means the yield or the coupons will go down. And what the market, what's basically happening is that the market's saying there's the amount that they can go down in yield up in price is starting to become more and more limited.
Right. Well, again, we hear about negative interest rates in Europe, right? It's like 23, $trillion of whatever it is and negative yielding bonds. It's just these immense amount of bonds that are out there. But they have negative yields, and it's not that companies or governments are actually issuing bonds and they're saying, okay, I'm going to issue this bond and you're going to pay me to have this debt. That's not what's happening. What's really happened is these are bonds with positive coupons. It's just the prices have been bid up to the point to where there's a negative yield that you get on the bond if you hold it till maturity. In other words, if you pay too much for the bond today, your yield to maturity becomes negative. That's what's happening. That could theoretically, everybody says you can't have negative yields in the U.S. The Fed won't do it, but you could have negative yields in terms of the 10-year Treasury if money keeps flooding into the 10-year Treasury note expecting that yields are going to go lower, bond prices are going to go higher, and I'm buying the bonds for safety. I don't want to be in stock, so I put it in 10-year Treasuries for safety and liquidity. We could have negative yields on the 10-year Treasury. That's not outside the realm of possibility.
Oh, it's certainly within the realm of possibility. And I would also say the Fed does not control all rates. All they really control is the Fed funds rate and, to a large degree, money market rates, Treasury bill rates. They don't control the 10-year, the 30-year, corporate spreads, junk spreads, mortgage spreads. So they influence, but they don't control it. And you're right, Lance, we can go below zero.
Well, but again, I think this is so. What do you do as an investor at this point, right? So we've been long bonds for a long time. We're getting to the point of where, there's not a lot of capital to get to zero. There's not a lot of capital appreciation left. So now we're betting on the function. If we're going to stay long bonds here, just for the trade purposes, right? We have to start thinking about negative rates. But this becomes very problematic for portfolio management because, you own bonds for the safety. It lowers the volatility in portfolios, helps protect capital. Bonds mature at face value, so we have some safety. But, what's the next? It seems to me at some point you're going to have a very sharp snapback in yields. I don't know what triggers that, but it almost seems at this point it's an inevitable outcome.
Look, bonds cease to become a hedge, right? Most people have these portfolios called a 60-40, a 70-30, where you own 70% stocks and 30% bonds. And you own those bonds because they pay a dividend, they pay a yield, but they also provide a hedge. When the market goes down, bonds tend to do better, and it offsets some of the losses on equities. But we're getting to that point where their value as a hedge is less and less, and it's unclear what people are going to do. And maybe that's one reason gold is going up so much, because it is an alternative.
Right.
Commodities are an alternative, but they've been getting hurt pretty bad so far.
Well, again, and again, this is where I think individuals are going to have a much tougher time because, our thesis has always been is that at some point we're going to be major stock bulls. And that was going to be the point after the next recession when valuations on stocks are suppressed. Valuations would be low on stocks, dividend yields would be high, and bonds would be hovering around 0% in terms of interest. So you would have this natural change to go out of bonds back into equities, but we haven't done that yet. We have yields now at zero, but valuations are still extremely elevated on stocks. So you don't have any place to go. If you want to come out of bonds, there's no place for you to go.
No, and let's be clear about that, right? Bonds yielding zero are the same thing as stocks at very, very high valuations. Very little upside in either one. But in bonds, it's easy because it's zero. It's easy to see zero. With stocks, all you see is a price. Why can't Apple go to $500, $600 a share? It's just a price, right? We saw Tesla go to 900 something the other day.
Right.
It's just a price, but it's not. It's a valuation. It's a market cap, and that represents the future earnings of the company. And at some point, there is a limit.
Well, and again, just kind of going back to this, I guess, the things we have to watch for now, though, is going to be some type of what seems that is going to be the case of this. Look, I'm just speculating here, but, things have gotten dislocated in terms of, the ideas about value and risk and these type of things, and money's flooding into areas specific to try to hide from risk to some degree, but it's actually pushing into an area that's now creating more risk, which is in bonds. Right. And it seems that the most likely outcome of this is going to be a dislocation somewhere in the bond market. And we've talked about the risk of the fact we've got so much in leveraged loans, so much in other types of credit events, that it's going to create a credit problem, which is the one thing the Fed can't fix.
I agree. This is going to show up in the corporate market, the junk market, the leveraged loan market, and there's been an incredible amount of borrowing by corporations, and I think you're right, Lance. That's where it breaks.
All right, wraps up the show for today. Michael Lebowitz, CFA, thanks for joining us today. And be sure to get by the website and get our latest articles and updates as well. Send us questions and comments. Always happy to help you. RealInvestmentAdvice.com and our professional subscriber service, RIAPro.net. That's where we get all of our portfolios right there for you to follow. RealInvestmentAdvice.com. Have a great day. And stick around, though, because Chris Salcedo is coming right up.
It's a rich man's world.